Good afternoon, everyone. I know you'll have had a very intense session a while ago, so we will try to make it as interesting as we can. Of course, you have heard the brief profile of the panel members here. So what we're trying to do is bring you different perspectives as far as real estate is concerned. And hence, Pradeep brings you the manufacturer's perspective, Ramesh brings you a very unbiased general perspective, and Vishal brings you, the investor's perspective. So what we try to do is start with the general feel of what the real estate market is in India is right now, and how it has kind of shaped up in the last couple of years, and then we take it on from there. So let me invite Ramesh to share his thoughts on the market before we move on with the discussion.
See, Indians, obviously everyone wants to invest in real estate. Enam had done a study sometime back on how Indians save. We are a $1.8 trillion economy. We save around 28-30%, which is around 600 billion. Of this, household savings is around $420 billion. In that $420 billion, Indians invest or save 160 billion in real estate, around 25 billion in gold, and just around 16 billion in stocks and mutual funds. So that's how important real estate is an asset class. Now, let's look at globally what's happening. Real estate has made a big comeback as an investment asset class. Many global pension and sovereign funds are increasing their allocations towards real estate. The Canadian pension funds have increased their allocations from 4 to 10%. To real estate. The Norwegian pension funds have increased it from 0 to 5%, and the South Korean pension funds have increased it from 2 to 7%. This is bringing in a lot of capital. Last year alone, global commercial direct investment was valued at close to $450 billion. And the last quarter of 2012 alone, we saw close to $150 billion being invested in global commercial real estate. Compared to second quarter 2009, which was the post-Lehman era, which was just around $20-25 billion. So, and this is very close to the peak of 2007 when close to $160 billion were invested. So, what's happening? Most of these allocations are going towards the big cities. So, the 40 global large cities is where most of this money is going. Money is going more towards markets which are transparent. Obviously, the developed world markets are very transparent. But the markets which have seen increase in transparency, whether it's Indonesia, whether it's Turkey, whether it's Russia or Brazil, have seen increase in capital flows. India has actually fallen down on the transparency index. So not much money has come in. Just in 7 and 8, what we saw was close to $10 billion of foreign private equity capital come into India in just those 2 years. This year will be the best year post that, where we expect around close to 1.5 billion of money coming in. On the demand supply dynamics, commercial India total office assets are close to 375 million square feet. Number looks big, but compare it to just one city like Paris. Paris alone has 570 million square feet. India, all these major cities put together has only 370 million square feet. So shows the potential for growth in the country. New York alone has 600 million square feet. So 370 million, but the worrying fact is the vacancy in India currently stands at around 18%, which is high. Just was around 3% in 2007. But the good news is that in commercial real estate, the vacancy levels, in spite of being at 18%, if you look at most of the micro markets, the top 4 to 5 buildings, grade A stock, if you take the vacancy levels, are less than 7-8%. So that's definitely something to look at. Residential, massive amount of construction is happening across the country. Demand in the top 7 cities for residential is around 150,000 units. But supply, as we talk, is close to 360,000 units which are already under construction. So close to 2.5 years of demand is already under construction in residential. Commercial, the good bet is if you had the peak of the Indian real estate market was third quarter 2008. If you had put 100 rupees in residential in third quarter 2008, you would have been at 140 rupees now. And if you put 100 rupees in commercial in third quarter 2008, you would have been at around 70 now, which is also an opportunity because the market has corrected. And in the last 1 year, we've seen the prices bottom out. We believe it's definitely a good time to invest in commercial real estate across the country.
Thank you. That's a very, very interesting perspective. I'm sure the numbers which Ramesh is sharing, I'm sure you would like to note down, because a lot of your investors and clients would be happy to hear of this number, because this actually gives you a feel of the depth of the market. On this note, let me invite Vishal to understand his perspective.
Okay. Thanks, Naveen. Is this audible?
I can hear.
Okay. I'll probably provide a different perspective. And this is really the perspective of the investor that we offer some of these alternative products to. And maybe it's, to try and summarize the mood, I would say two words. One is that of caution, and the other one being a bit confused. Let me try and elaborate why cautious and confused. Caution, because I think from a paradigm standpoint, what we've seen over the last couple of years is risk getting reduced in their general openness. And what earlier started as private equity has become now private debt. So in the real estate space, we've seen, therefore, participation actually change in the nature in which customers want to participate. And if you generally think that debt is lower risk than equity, then I think risk appetite has actually come down. People are happier to see regular flows of cash and interest coming off, rather than wait for a big lump sum at the end of 7 years or 8 years or 9 years.
Right.
So I think that's one theme that we see as one of caution. Doesn't mean they're out. They're still looking for opportunities. This is clearly, I think Ramesh articulated the opportunity in the sector. So that's very much there, and they see that. But the way they want to participate has taken a big change. The second, which is confusion. Where's the confusion coming from? I think one part of the confusion is that they see the headlines about how people have made pots of money, but that's not reflecting as yet in their investment portfolio with an AIF. So that's a bit of the confusion, which is, had I bought my own property, where would that have been? Now, I think all of us know that that's subject to so many exit, costs, etc. So it's not necessary that if you see the headline of something selling at 1 lakh rupees a square foot, that your property would have sold at that price. But the fact is, that's the confusion, I think, in the investor's mind, that the next headline that makes some newspaper becomes the way that you start valuing your own property. And then you say, okay, my alternative investment doesn't seem to be generating that sort of return. So I thought I was doing a good job by giving it to a professional fund manager who gave me diversification and all of that. But where's the money? So that in a nutshell, and I know that we have a tight session, Naveen, so I'll hand it back to you. I think those are the two things I would think as how investors are thinking about this opportunity.
Thank you, Vishal. I think all of us experience this almost every day. And which is where I think the right person to get in is Pradeep, because from the fund's perspective, these are the hard calls, these are the tough questions which we guys keep getting asked. So let's just hear from Pradeep as to what's his view on the market in general.
Sure. See, this real estate investment management business started in 2005 with the opening of markets. This business started from a private equity model, and it has moved to a private debt, as he rightly pointed out. But clearly, this is a paradigm shift towards the structured investments. See, if you see that post 2005 to 2009, that approximately around 80-90 billion USD would have been invested from offshore in form of FDI investment, and you take another 7-8 million from a domestic. That's a huge quantum. And majority of these funds were invested at a land stage or a one step before that, okay, land aggregation stage, okay, without the focus on exit, how the investors would get. And these funds for a relatively longer tenor where the investors haven't seen the light of the cash flows. This has moved to a totally exit focused strategy from a fund houses, okay. Domestic investors have done reasonably well compared to offshore investors. There is a flexibility with respect to domestic fund. But having said that, domestic investors are more clued on, in my view. the market is definitely shifted towards a structured investment. It makes more sense to invest in real estate by way of a structured debt or a mezzanine transaction. Mezzanine is a debt with the equity upside. See, you need to appreciate that how the real estate functions in the Indian market. Real estate is rich in value, poor in liquidity. You need to appreciate that. Real estate in India is still a locational specific and promoter centric game. What I mean to say that every city has got its own development control regulation. Every city has got its many micro markets which may behave in a different fashion altogether. Key is to identify the location, right location with the growth drivers, with the availability of social and infrastructure sector. And I would like to say real estate is a promoter-centric game. See, it is imperative to have an alignment of interest with the developer. If you are partnering with the developer, okay, it makes sense the developer has a strong credentials in the development capabilities, it's strong in that particular geography. Pan-India model hasn't worked in so far. DLF has not been successful in Bangalore. Otherwise, in the current scenario, Bangalore is doing reasonably well. So if I'm doing a deal in Bangalore, I would prefer a Bangalore-based developer. Another shift is towards focusing on the cash flows. Cash is a king, as you know. So earlier, the opportunities were available at a land aggregation stage. In last 2 years, we have opportunities available at a late stage, last milestone, post-approvals, okay, where there is a clear visibility of cash flows, money coming. How we have structured the product is like this. Investments are typically by way of a structured debt, and the money comes along the way of the tenor. Okay, there is no free lunch in real estate. Real estate developer in a pure equity deal will not allow you any unlimited gains. Okay, the pure equity deals haven't worked. That is our experience. That is where the industry is structured. Given the fact that fund has a definite tenor of life, it makes sense to invest through a structured debt. Focus is primarily on residential projects which are self-liquidating in nature. I don't deny that there is a huge opportunity in commercial space, but how do I get an exit as an investor? Unless the REIT guidelines or other guidelines are in place. Without that, I will not get able to get exit to my investors. So focus is predominantly on residential asset class, which is self-liquidating in nature, primarily in top 5 cities, top 7 cities. Why top 7 cities? Because these markets have got more depth, liquidity. See, another key learning from our experience is that there is no substitute to due diligence. You have to do a full-fledged technical, financial, legal due diligence on the property, and you need to develop that skill set. That skill set cannot be developed overnight or maybe with the vendor's help. You can't do it. Every industry has got its own learning curve. Having said that, there is no substitute to managing the cash flows. See, managing the investment, managing the cash flows are equally important, okay, as making the investment. That's where most of the fund managers or many fund managers were not able to keep the track of the cash flows. See, in last 2 years in Reliance, we have done around 20 transactions in top 5 cities, would have deployed more than 1,000 odd crores. We have got back around 500 crores max. That means this concept is working. This is a proof of our concept. You manage the cash flows, you escrow the cash flows, you manage that you ensure that there is no leakage of income from the system. That is how you are able to return. See, we are doing deals in a high yield space ranging from 20 to 23%. These are basically equity returns with the debt structure. I would also like to say that in a debt structure, whatever you covenants you put, if there is no cash flows in the project, it is bound to fail. Okay. Or if your partner is not credible, then however good deal is, it may potentially turn out to a bad deal. So another learning is that you need to identify a credible developers who have a track record of execution, who has a track record of credit history to some certain extent. And see, in current scenario, the real estate is passing through a transition phase. Okay, There is a caution, as he rightly pointed out, there is an opportunity. So a fund manager should know when to invest, where to invest, what stage to invest, in what format to invest. This skill set has been derived over a period of time. I think real estate has got immense opportunity. Even in this downturn market, we are able to generate good cash flows, good pipeline deal flow, good returns. And as far as commercial asset class is concerned, I think it will take a while till the exits REIT or this REIT guidelines are in place.
Thank you, Pradeep. I think two key takeaway points from what we just heard is one is that the reason why we find the change in the structures of the new initiative which are coming in is because one, from an investor's perspective, what the investor is looking for is an investment where there is a visibility on cash flow. If there is no visibility on cash flow, he is extremely careful. And which is where you find the changing trend, the erstwhile conventional way of doing private equity into real estate, where, as Pradeep said, it used to go all the way from land acquisition upwards, has actually undergone a change, and now you find a lot of structured-based transactions happening because that's the only way you can provide a visibility of cash flow. So now bring it down. Let's bring it down to a more specific set of questions so that we make it a little more meaningful, having understood the basics. So, while you did cover, Ramesh, quite a few factors, if you have to pick up just 3 factors, which are actually the primary drivers of this changing scenario, as far as the investment from the manufacturer side is concerned, or investment trend from the investors is concerned.
Trend, what we're seeing is a lot of HNIs, LPs have burned their fingers. So they're looking at the private equity investment with a lot of caution. I think it's very wrong to kind of paint the entire industry with one brush. Every industry has bad apples. I think the private equity industry also had bad apples. So there's some funds which have given decent returns, at least domestically. Internationally, I don't think any fund has given back any decent return, obviously because of the currency fluctuation issues. From a domestic point of view, when you are advising your clients in terms of what to look for, I think in a market like India, one thing which obviously everybody has to look at capability, track record, look at what's the strength, experience of the management team, the board, the promoters of the fund, look at what's the reporting standards, what's the management control on the funds, corporate governance, all that is things which one has to look at. But I think one aspect which went unnoticed or I think HNIs didn't do enough due diligence was integrity of the GPs who are running the fund. I think that's where quite a few people burn their fingers. I think going forward that becomes quite important. A lot of bad deals were done. Those deals could have been avoided. I think that's a trend which we are seeing. We are quite sure that 2014 will see the passing of the REIT legislation. It may not happen so fast because a lot of questions are still unanswered. That brings in a lot more transparency, that brings in a lot more liquidity, that brings in another asset class for this group to sell to their customers. So we believe that will definitely kind of, the third is we are definitely seeing a lot of transparency coming. Okay, last 2 years has not been that great from an India image point of view, but over the last 6-7 years, the amount of cash in real estate has come down. Much better corporate governance, much better investment guidelines, a lot more due diligence happening on deals before investment. So I think overall, a lot more professionalism, a lot more transparency in the industry.
So the element of cash flow has reduced. It's good news, right? Because real estate is associated with this word like this is the only sector which can consume a lot of black money in the form of liquid cash. So this is good news. So thank you, Ramesh, for bringing this piece of cheer on everyone's face. Linked to that is a question for Vishal that obviously there are factors which are affecting investors' decision making. But having said this, in the last last 2 years especially, one has seen a growing trend towards actually acquiring real estate by the high net worth individuals as part of their direct allocation to real estate. Have you been experiencing the same? And if so, what do you think is the trigger point? Why are they behaving this manner?
I think, yes, customers have been buying direct real estate, and that's where the opportunity for this industry really is, which is if we do have a better product, better diversified, better managed, then really we have to question ourselves and saying, why do they have to go direct and take a single property exposure rather than go through technically a better instrument? 2-3 points. One is that of leverage, that yes, you can borrow and therefore your equity can buy something which is significantly larger if you buy directly. Second is, like I mentioned previously, experience seems to be that this is my property which has a valuation that is under my control, and somewhere down the line my mistake is okay, but if you make the mistake it is not okay. So unfortunately that is part of life. Third is, I think with some amount of what so-called stress, deals have become far more available. So I think some feedback we get is that the developers, etc., are willing to talk and negotiate far more now than they were 3 years back or 2 years back. So in that sense, what you perceive you are buying is of far better value than 3 years back. So in the past, unless it was a large fund that went and negotiated and got me a good deal, I would not get a very good deal. But today, I find that me and my friends can go and strike a deal which I think is attractive. So to that extent, a bit of retailizing of value has happened, and that may make it more accessible for HNI to directly get exposures. Having said that, we also did see a fair amount of real estate debt being bought last year. So that space also does coexist. So I wouldn't say that all the money is only going into direct real estate. Keep in mind that interest cost has been pretty high. True. So that's a bit of a deterrent, and therefore structured real estate debt has been quite attractive for a lot of HNI.
So will it be fair to say that the larger number of investors who have in the recent past exposed themselves to the debt kind of structures with the developers directly in the form of structured coupon instruments and are not necessarily having a very satisfactory experience in the last 1 year or so. Is this one of the reasons why there is a negative opinion being formed about the real estate sector from investment perspective?
Not necessarily. I think, frankly, I don't think there is a major negative sentiment per se. Okay. The way the investor looks at it is great value. So when I think the newspapers talk about the fact that there is a bit of a liquidity crunch in the real estate sector and generally cash is at a bit of a premium, as an investor one might think that, look, if I have cash then I should get a premium and therefore I can get a better deal. So the fact is I am going back to that asset class, which means I'm not completely shut off from that opportunity. So I don't think there is an overwhelming negative per se. The demand statistics and all the other macro opportunity that we spoke about just now really is something that customers also see. It's just that your choice of participation has really been either you go direct or you go through a real estate debt sort of product rather than a PE participation that we saw about 5-6 years back.
So the investor has become cautious, one because of his experience in the past, and two also because the general sentiments, which has battered all the other asset classes also in the last couple of years, is actually prohibiting or rather restricting him from taking exposure to any form of investment. Will it be fair to say that?
That's right. And a bit of this is also nothing to do with the real estate, necessarily to directly do with the real estate market. Let's keep in mind that risk appetite in general has been very low over the last 3 years. So when you look across asset classes, it's not like we are selling a lot of equity, which is the other risky asset class. So in general, when you have a macro environment where customers prefer the safety of debt and cash flows, I think there's a bit of a rub-off on this sector as well. And the opportunity has been presented with some amount of structuring of real estate debt. So in that sense, it's a natural flow. I don't think there's anything structurally wrong. It may just be that in a couple of years' time, if you see risk appetite comes back, then maybe the old PE structures may also be back.
Pradeep, do you think this is happening because maybe as a private equity industry, we have yet to come to a level where we can start calling ourselves a mature industry? Because I don't think we have got too many funds which have been able to complete the entire cycle and been able to, live up to its commitment in terms of the capitals, the appreciations, or the return part of it.
I agree with you to some certain extent, but at the same time, I would like to tell you there is a stress in real estate sector at this point of time. This stress is locational specific, depending on the liquidity position at the developer's end. And the real estate is an integral part of the domestic economy. When all other sectors are bleeding, how can you expect the real estate to be insulated from the overall downturn? We are feeling the impact in real estate, downturn impact in the real estate space. At the same time, there is why the opportunities are there for investment. See, with respect to private equity model, see that hasn't worked because the private developer will not get you that abnormal returns. Okay, it may be better to structure the investment by way of a structured debt or a mezzanine. Okay, where you take a minimum fixed return structure and then go for an equity upside, because you will not get the unlimited returns from a developer the way the industry is structured, given the status of industry at this point of time.
Okay, so this brings us to a very interesting point where I think I would like to ask Ramesh to bring in some perspective of what has been the experience of other countries which have gone through similar phase the way probably India is experiencing. Probably maybe say China. US may not be the right comparison right now.
I don't know much about the Chinese market, but real estate globally, like I mentioned, that $450 billion, which is direct commercial investment. This year, that number is expected to go to 500 billion. And we are talking of just 1 billion of that in India. So that's the kind of capital which is available across the world. Now, if you look at, a lot of it is going to the emerging markets. I mentioned about markets which are showing huge amount of transparency. If India can show transparency, there would a lot of money which will come in. Where is that money going? Which asset classes does it go in? 50% of it actually goes into office. 25% of that goes into retail. Around 13% goes into industrial, and 7% goes into hotel. So very less of actual direct investment happens in what they call multifamily, single family kind of. That's typically end user driven, even out of the country. Lessons concentrate on the big cities. Globally, investments are happening almost in the top cities in each of the countries. The top 5 cities where the maximum investments are happening globally are New York, London, Tokyo, Singapore and Hong Kong. It's there in the top 6-7 markets. So those are some of the lessons which one is seeing outside the country.
In fact, just some time back, I came across this article which was published by this research firm based out of Singapore. Very interesting. I mean, I wish I had the piece of it. Probably could have just shared it with you. The trend which we are seeing in India right now is the trend which actually is sign of maturity, and we have had enough and more examples, across different asset classes which we have experienced in the last maybe 15-20 years. In real estate, and why I say this is because if you recollect, just go back 4 years, and the kind of instruments which were being created, towards concluding a transaction, that itself has started undergoing a change. Okay, and just to simplify, a pure play equity linked has now moved to a level where you find actually combination of equity with debt. And probably, going forward, you might even have a concept of preferred equity coming in. See, these are the concepts which in markets like US were tried and tested about 15, 20 years ago. So the takeaway was that we are going through a phase where some bit of delay is bound to happen, because in India, as we all know, we are yet to have a regulator. And unless and until we have a regulator, the set of do's and don'ts are very clearly defined. We will have a huge amount of macro factors impacting us. So everything which you are hearing here are actually an outcome of a lot of these things, especially the way the market has changed in the last 5 years' time. I think it's an outcome of a lot of factors which probably were perceived, and a lot of them were not perceived. And hence, we actually are seeing a lot of. So having said this, it's important to also say that, yes, we will continue to see a lot of changes happening in this real estate industry. And especially from fund management perspective, you will come across a lot of changes, not only to the extent of the kind of transactions happening, but also the variations of what we have seen so far as far as real estate is concerned. So let me just bring it back to the panel and probably ask a straightforward question. So, Pradeep, given what Vishal said, that a lot of investors have not had very fulfilling experience investing in real estate because of various reasons in the last couple of years, would you think that a delayed fund result is equivalent to a bad fund result?
Not necessary. Okay, there is always a learning curve. I also understand this is a cycle. Which one has to go, and it may not. You can learn from your past mistakes and move on to the next level of fund. But having said that, we are talking about the debt funds. See, our view is these returns are also not sustainable. This is a cycle, probably 1 or 2 years down the line, these returns may not be sustainable. We may not be able to get such kind of a returns in a debt format. So we may go back to a mesh structure doing the deals or equity deal.
Okay, so looks like we guys are heading towards happier days again. Ramesh, you feel the same, that probably real estate industry is heading towards the happier days again?
See, I would get scared if one is getting 25% capital appreciation in a year, which just shows that that market is highly volatile. We saw that in Greater Noida a couple of years back, and things have come down crashing. So I think going forward, real estate should be seen as, from a capital appreciation point of view, from a 8 to 12% kind of a mark, which is steady and stable. Today, most markets, called the BCHP markets, the Bangalore, Chennai, Hyderabad and Pune, markets which are very end-user driven, markets where there's very little cash, very little speculators involved. Most of those markets we can see over the last 2-3 years have been growing at that 10, 12, 13% kind of mark. I think that's what you will see going forward, and you should be happy that the market is going in a stable, steady manner. So don't invest in markets which suddenly someone comes and tells you you're going to get a 30% capital appreciation. Please stay out of those kind of markets.
I think this was very, very informative, and leading more to Vishal, that in that case, what do you think, Vishal, should investor or a LP look from a GP while investing in any private equity?
I think it really depends on the state of the market at that point in time. Let's all appreciate that current macro views and therefore sentiment has a fair amount of play in the way people are looking at an investment opportunity. But I think the fundamentals around choosing any fund provider or partner quality, transparency, the ability of the management team, and all of those still are as true as they were maybe 10 years back. So I think that's there. From the immediate worry that I spoke about is around cash flows and therefore visibility of returns rather than a sort of a black box that I wake up 7 years later and figure what my money is worth. So things around reporting, transparency of valuation, and the ability to sort of throw some cash back through exits. And I think more confidence around exits is something that can definitely help.
Thank you. This I think pretty much sums up what we wanted to share with you. Do we have time, or are we almost running out of time? We are, okay. So before we wind up, I think it's important that we hear a word of advice from people who are expert in this space. So Ramesh, your advice to the wealth managers and investors.
My advice would be look at commercial in Bangalore and Mumbai, residential in Bangalore, Chennai and Pune. Retail, please don't buy malls which are up for sale. Buy high street if you have. Land, unless you understand the real estate market really well, please don't do direct investment into land. And if you're looking at private equity investments, please check a track record. Please check the track record, because there are many funds which started in 2005 and 6. So today you can check their track records. Look for funds who have given some amount of returns back to their investors. And I mentioned this earlier. Look closely at the integrity of the GPs.
Thank you, Ramesh. Pradeep.
My advice to wealth manager would be, you ask your investors what is their investment objective, what is their tenor, okay, assess their risk appetite. If they have a longer tenor time frame and they can absorb the higher risk, probably they can go at a land stage. If the concern is on the timelines, better to suggest to them invest through a platform, okay, through a professional fund manager in a structured debt format. And if they are looking for a stable stream of income from a commercial asset class, then they can buy the commercial asset class. Maybe a good time to buy the commercial asset class at this point of time. Nobody has producing the commercial asset class for the last 2-3 years. Existing whatever inventory is there would be absorbed in next 3-4 years. So it is no brainer. 4 years down the line, prices of a commercial asset class would 4-5 years down the line, but you should have a holding capacity. Okay, don't expect that building would be leased out in a time frame of 6 months or 1 year.